This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Joining us today is Jason Brewer, of course the CEO of Marula Mining, following news this morning about their manganese interest with gems and industrial minerals in Kenya. So thanks very much for joining us today. Jason, how are you doing?
Mark, I'm doing very well. Always a pleasure to talk with you as well.
Indeed. Well, of course, we spoke about this venture. Well, it's early March, I think, when you first announced it, really. You were saying it fits in the strategy of the critical metals in Africa, which is what you want to broaden out on. It's currently producing, has been since 2012. And today you've announced that effectively exploration activities have started. So I wonder if you can just perhaps take us through the initial exploration stages that you're going to go through on this project.
Of course, yes. Collins Asito, who heads up exploration for the group here in East Africa, and two of his recent appointments went to site last week. And part of the initial work was to complete a broad mapping and sampling program, and primarily aimed at establishing strike extensions and the continuity of the high-grade manganese ore that you see in the three small open pits that are already there. So that's the first phase. That's already commenced and has already been very successful in terms of the results and the feedback that I've received already.
Okay, good. Well, I wonder if we can just perhaps go through some of the, we went through briefly some of the numbers last time, but I understand at the moment it's producing around 5,000 tonnes a month. You want to get that up to sort of 10,000 tonnes by putting in new mining and crushing and screening equipment there. And you've got quite a bit of cash that you've got to provide, haven't you? Really, you've of course got the investment there of $1.5 million US for all of those elements, but of course then there's quite a significant amount of capital that's being used, but it's through shares, isn't it, to actually acquire the project there. So I mean, there's quite a bit of money that you need to find. Are you able to find it? Okay.
Yeah, look, I mean, I'll step back. Yes, the operation's been going intermittently for the past, 10, 12 years, and hasn't achieved those 5,000 tonnes yet, Mark. That's a target we've set ourselves, an initial 5,000 tonnes of saleable product, going up to 10. And realistically, it's got to be producing over 20,000 tonne a month to make some meaningful impact for us as a group as we move forward. So we've gone up there. The guys have already reviewed the stockpiles that are there, some of the surface exposures. There's three small open pits, which probably extend together at over 650 meters. The mineralization you can see in a trend, and that trend extends over 5 kilometers. We've confirmed already on the two mining rights that are in place that the manganese mineralization is located, over 2.5 kilometers south of one of those open pits. So, we've got a lot of confidence in what we see. Part of what we're looking at, as you mentioned there, is getting the production rates up to 5, up to 10, and then down the track up to 20. We have to bring in new mining, new processing, and crushing equipment. And we're expecting that to arrive in late April. And the costs of that are about $1.5 million. I've been in South Africa 2 times over the past 4 weeks. And part of that is to be finalizing those arrangements with our team at QGC. So that is not going to be a big cash outlay up front. That is going to be on a structured basis going forward. So that certainly helps our working capital. Mm-hmm. But also in the meantime, what we've had a crushing screening specialist up on site with Collins and his exploration team. And they were doing a full assessment of all the equipment there, the excavators, the crushers, the screens. There's been a few good wins which have come out over the past week. So we're going to be refurbishing and upgrading that equipment now to allow us to basically start ramping up production. And I can talk, maybe one of your subsequent questions is going to talk about the offtake, and we can touch on it there as well. But obviously that's something we're looking at as well. But on the equipment side, that 1.5, yes, that's there. That's a funding requirement for us, but we're being smart about it. And then we're going to be spending about 1.75 million on exploration, which includes survey work and drilling. And we've gone through our budgets out of Blesberg, out of the group, and that's more than adequately covered there. So we're very comfortable as a group moving forward with the commitments that we've made here to invest in the project directly. But then we also, as part of our acquisition, we have shares or cash payments to make vendors to secure our interest, which is an initial 60% going up to 70%. So, what we want to do as a group is move away from using our shares as our currency, which we've done to date, and start using the cash flow from operations to start to pay for all these increased project interests.
Indeed. So, I mean, you've got over sort of 3 million there, really, that you're committing to spend in cash on the project. That's right. Yeah. So that is a lot of money, and it's funded, you say, from operations from Blesberg, but also through QGC.
Through the relationships we've got through them on the equipment leasing. So through QGC, obviously at Blesberg, we've got some brand spanking new mining equipment. People would have seen the photographs of all that Bell equipment, the excavators, the ADTs, the dozers, the loaders, and so on. And through having secured that through QGC and under standard leasing arrangements, we've now been able to secure that equipment and other equipment in our own right because of, I guess, our credit position, our perception by them as a supplier who has improved dramatically over the past 12 months, given the performance of Blesberg.
Mm-hmm. So what's in it for QGC? How does it work? Because they're not going to just effectively provide all this access to capital or equipment for free, are they?
No, look, they're going to be a major shareholder in the company, as you know. And one thing we're very focused on, and we talked about it just offline there, Mark, is I respect all those companies that are paying dividends. And for QGC to make a return out of their investment in us, certainly the share price has performed well for them. So they're well up in their investment. But they want to see cash coming out of the company. They want to see dividends going to them. And if they're getting close to being a 30, 40, 50% shareholder, then the sort of dividend payments that they're expecting to see, that's how they want their return. So they're certainly not giving us these introductions, providing capital because they're a charity. Far from it. They're led by a very savvy businessman, as you know, Quinten van der Berg, who you met. So they're looking for a return, and they're expecting us to start giving them that return over the course of this year and next. So they're expecting dividends very quickly.
But every time they're involved in some kind of capital element of the business, their share increases in Marula. Is that right?
We had that initial 5 and now a 6 tranche transaction with them, where they've agreed to invest $5.5 million into our company. To date, they've invested about a bit over $2 million.
Okay.
And there are further tranches available to us as we advance our activity in Tanzania, but also as we advance Blesberg further. So a lot of opportunity for them to get involved and support us. And look, they're a long-term holder, as you found out with your interview with Quinten. He's here to build companies. He doesn't see Marula as a small-scale operation, small-scale junior mining company. So he wants us to grow significantly. And remember, we were his first listed mining investment. And, it's certainly something which forms the basis of the fund, that $1 billion fund out of the Middle East that he's secured funding for to invest in more battery metals projects.
And the percentage they'll end up with will, of course, depend on the share price effectively and when things are when capital is released. But have you got an idea what they could end up with, really?
Look, Quinten has made it very clear, and QGC's made it very clear they want to be majority shareholders in their investments.
Right, so over 50%.
Over 50%. Okay. So that's their target. How they get there? Through existing tranches and agreed funding, but anything over and above that, has got to be in the best interest of all shareholders. So
indeed, yeah, because of course dilution will be on people's minds, won't it? Massively
so, and as I've been pointing out here, with the manganese at Larisoro here in Kenya, we're going to be in cash flow, next quarter. So our reliance, and with Blesberg as well, and then in Canusi on the copper. So we're not going to be in a position where we're going to be reliant upon, your traditional equity placements to bring capital into the business. We've transitioned within it's going to be less than 2 years, Mark, since getting involved in this company, that we've taken it from a shell to hopefully a company that's got 3 producing assets. So, and then one that doesn't become reliant upon the equity markets and the fickle nature of brokers and whatever to fund our future kind of activities. So that's the strategy. And so for Quinton to get a bigger share of the pie, well, he's either got to buy on market or he's got to support us in ways which are beneficial to all shareholders, not just QGC.
Okay, good. Well, you mentioned there about the activities, the mapping, the sampling of the manganese mineralization, the refurb you're going to get into in Q2, and you got the offtake trial, effectively, of 2,000 tons in Q2. So just give us a bit of an idea about this offtake partner, who they are, how the trial period was sort of agreed, and when you want to try and get to that 5K.
Yeah, look, we've literally, before we actually announced the deal, our offtake partner, our preferred offtake partner, had already been up on site and had actually tested the material. So when we report, I think we did some assay work in December as part of our due diligence, and they were the ones that actually assayed and tested that for us, and it came out at over 37%. And 37% is almost that benchmark material which comes out of South Africa. You know, it's the one you see quoted in the markets there. So that gave us a lot of confidence. The fact that the partner that we're using has offices, we're already working with them at Blesberg. So, you know, people don't have to be too smart to work out who they are. They've got offices here in Kenya. They've got port facilities here in Kenya, and they're busy transporting commodities throughout East Africa. So that works very well. In discussions with them 2 weeks ago, it was agreed that we would deliver to them a 2,000-ton parcel of ore, almost as a test trial parcel. We expect to get that done over the course of April, and on the basis of that, look to establish a more longer-term offtake arrangement. Okay. From a production profile, moving from doing your 2,000 tons next month, going up to 5, going up to 10, look, that's going to be equipment related. So over the course of of Q2 this year, we expect to be able to get up to that nameplate capacity. The crusher and screens that we're bringing in are being put in place to be able to deliver 10,000 tons a month of saleable product. So over this year, over 2024, we'll be ramping up towards those levels. Okay. And if we have the logistics support, the ability to get this material to market effectively and costly and in a cost-effective way, then we'll go over and above that.
Right. Okay, well, thank you for giving us an idea of that. And as you mentioned there, that 37%, that's important. Last time you told me that this sells for effectively $3.91 per percentage point. So at 37, that's $144 there per ton, effectively. And your cost was about $77 a ton. So, you know, well over 100% margins there, and you talked about getting to that 5K would get into about $335,000 of free cash flow. So that's where you can see the return coming back there. So, I mean, is it all looking okay for that? You mentioned last time that you wanted to actually increase the grade, if you could, to 44%. So, I mean, can you give us a bit of an idea? We've talked about the offtake, we've talked about ramping up. In terms of cash flow projections or thoughts, what would you say?
Yeah, look, we're looking at obviously maximizing the returns to us, and you do that from a number of points. You look at it from your operating cost perspective. One of the big operating costs here is logistics. Okay, of any bulk commodity like this is logistics. So we've already been engaging with a number of transport companies here in Kenya to basically optimize that transportation of the material from Samburu down to Nairobi. And we're starting to receive quotes. We've got the historical quotes. We're going to look at obviously trimming that back as best we can and making sure that we're getting the best price possible. From an operating cost perspective, this operation beforehand was beset with inefficient, poorly performing, poorly maintained mining equipment and poorly maintained and operated processing equipment. So we're expecting to improve our margins through the new equipment, the larger scale of that equipment, and through its efficiencies. The other aspect or way of doing that is on the revenue side. How do you maximize your revenue? Well, by grade. And part of what Collins and his team has been looking at is identifying those high-grade areas of the mine. Beforehand, there's been no geologists actually assisting in the mining process, making sure that what you're mining from the pit is that high grade. So there's been a lot of waste. There's been a lot of sorting required of this mineralization. So you can actually start improving. If you get over 40%, then you're starting to make some very good returns here on the grades. Now, you've seen, Mark, when we were talking, the price there, that FOB price out of South Africa here was $3.91. It's now up at $4. So, and it's been consistently moving up over the past several months. So it's going in the right direction. There's been some disruption to one of the highest grade suppliers out of Australia, one of the highest grade and lowest cost suppliers of manganese ore out of Australia. So that's had a big impact already on the market. And that operation there is not expected to get back to its steady state operations for quite some time. So the market this is a nice little win for us in the short term, particularly as we're producing now. So yeah, the economics of this look robust, and that's why we got involved in it. It ticks all the boxes from us from a strategy point of view, from a commodity mix, and having people here on the ground in Kenya means we can actually push forward very quickly and deliver on it.
Okay, good. Final quick question, because you mentioned it there, cash flow from Blesberg. We, of course, talked about that offtake agreement being signed last time we touched on Blesberg. When are you hoping to get that cash flow coming in? Because at the moment, it won't actually be generating cash, will it?
No, we've got to get the TOMRA unit down there to really maximize those returns. So the phase one operation there includes both the TOMRA and the Rados plant in series.
Yeah.
And the TOMRA plant having 5 times the capacity is going to remove the quartz from the mineralization. Because remember, you've got the quartz, you've got the feldspars, you've got the mica, you've got the tantalum, and then finally you've got the spodumene. So, with that, so over the course of April, and our first scheduled delivery is obviously in May. Okay, so that's when we're expecting, from our base case analysis, that's when we're expecting that cash flow to start to produce. We've got new equipment arriving on site. We've just completed the final plans for the new crushing, screening circuits as well. So we've constantly been upgrading them. So yeah, Blesberg is going to be kicking in. Look, Q2 2024 is going to stand out as quite the quarter for us.
Okay.
Blesberg here in Kenya at the Manganese. And we're hoping as well to deliver on Canusi as well later in the quarter. So yeah, it's going to be quite the start to the year that we're hoping for.
Okay. Well, thank you very much for your time again, of course, Jason Brewer, the CEO of Marula Mining.
Mark, many thanks as always. Good talking.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.